Good morning, students, and indeed all our viewers. We welcome you to our lesson today, Business Studies Form 4. Last time we began, in our previous lesson, we were looking at financial statements and ratios. Financial statements and ratios. This was our topic of discussion in our previous lesson. And we highlighted various concepts that we need to understand in this topic. And one of them, we highlighted what we call preparation of a statement we call the trading account. And we said a trading account is one of the main statements that we need to prepare in this topic. We said that we prepare trading account mainly to be able to determine gross profit that is made within a given period of financial accounting. And then number two, we looked at what we call the net profit. The net profit, we said, it is prepared by a statement we call profit and loss account. Profit and loss account. These were two important statements that we prepared in our previous lesson. And today we want to finish up on this financial statement by preparing one of the very important statement, which is mostly tested in Business Studies Paper 2. So in our lesson today, therefore, we want to put our concentration on what we call the trading profit and loss account. Trading profit and loss account. Now, this is one statement that has two, in which case we have the trading account and then the profit and loss account combined together to form what we call the trading profit and loss account. What we need to understand, even before I give the format of the trading profit and loss account, is that when we are looking at the profit and loss account, there is a part we talk of expenses. We talk of expenses being debited or being written on the DR side of the profit and loss account. Profit and loss account. And then we have revenues or incomes, which are captured on the credit side of the profit and loss account. Profit and loss account. We need to understand one thing about expenses and revenues. When we are dealing with accounting, we have to know how to make adjustments to these expenses and to the revenues. And the key adjustment that we make here is sometimes we make payments in advance before the service is offered. We call them prepaid expenses. So if we have prepayment or prepaid expenses, this simply means payment in advance. Payment in advance. If a business makes a payment in advance before the service is given, then to make adjustment to the expense account or to the revenue account, we subtract the prepayment from the actual value of the expense. So this one is simply subtracted from the expense amount. If, for example, we had captured salaries as an expense, salaries as an expense had been given as 40,000. If a business incur 40,000 within 1 year, and then it had made a prepayment, we are given a record of prepaid salaries of 5,000 shillings, then to obtain the actual figure for the salaries that will be captured in the profit and loss account, we'll now say it will be 40,000 minus 5,000, which gives us 35,000. So we record 35,000 and not 40,000. Equally, not 5,000. And this 5,000 that is prepaid is taken to the balance sheet. This one is carried to the balance sheet. On the debit side of the balance sheet as a current asset. So all prepaid expenses are transferred to the balance sheet as as a current assets. Remember, we have current assets and fixed assets. Number two, we have what you call payment that is made after you've offered the service. We call them accrued expenses. Another name for accrued is outstanding expenses. Outstanding expenses, or it could be payment due. Or it could be payment due. These payments are made after the service has been offered. And so when we are adjusting, what we do is we consider the actual expense account, and then we add the accrued expenses. We add the accrued expenses. So in this case, if, for example, a business had a record of rent, as an expense amounting to 100,000. And then we are told the business had an accrued value for rent, as 25,000. Then in calculation, to determine the actual value of what we record in the expenses under the rent expense, we will take this value and add. So we add accrued to the real rent expense. So this gives us 125,000. So this is what will be captured in the profit and loss account, 125,000 as an expense or in relation to rent. However, when we are now making a balance sheet, we transfer the accrued rent to the balance sheet. This one is transferred to a balance sheet. On the right hand side, that is the CR side, as what we call short-term liability. So that is how we need to understand the adjustments that we need to do when we are looking at the trading profit and loss account, and more so when you're preparing for our exam. Remember, I've mentioned the adjustment based on the expenses. They do also happen when we are talking about revenues and incomes. So the same thing, if you're given a revenue and then a prepaid revenue made, you simply subtract. Then if you're given accrued revenue, you also do add to get the actual figure that you record in the profit and loss account and what you'll record in the balance sheet. So we transfer those two to the balance sheet. It is important to know them before now we highlight what we need to prepare today. Therefore, our students then, let's see what is this trading profit and loss account. How does it appear? The format of the trading profit and loss account is very simple. What we need to know, first thing is we indicate the name of the business. The name of the business. Maybe you'll have, this is James and James Limited. The name will be James and James Limited. If you had, for example, Makindu Traders, you write Makindu Traders. Then below it, you indicate the name of the statement, which is the trading profit and loss account. Then below it, we write now the date. And then we prepare the trading profit and loss account for the year. After a given year, so we say for the year ended. For the year ended, or for the year ending, whichever you'll use, then you give the date. We have two sides of this account. We have the debit side and the credit side. On the debit side, the first item that we captured in the trading account, because the first part is the trading account, we said we record opening stock. Opening stock. Once we record the opening stock, number two, be able to add what we call purchases. If the business made purchases, we add purchases. Then we add carriage inwards. Carriage inwards. Then we subtract purchases returns. And we say the other name for purchases returns, it simply returns outwards. And so once we have this figure. What we obtain here is a figure that we call the cost of goods available for sale. Cost of goods available for sale. Then we less the closing stock. We subtract closing stock. We subtract closing stock to get what we call cost of sale. We obtain what we call cost of sale. Now, once we are at this stage, then we go to the right-hand side, and the first item, sales. Record the figure for the sales. Subtract sales returns. Another name for sales returns, returns inwards. So we have less this to get what we call net sale. And this figure for the net sale is dropped down in case for balancing purposes. And so we ended our statement. And then we do the following. We look at the figures on the CR and the DR, which one is higher? If we realize that what is on the CR is more than what is on the DR, then we obtain what we call gross profit carried down. Because in that case, you have more income than how much you've spent to get that particular income. So that is gross profit. But if cost of sale will be higher than the net sales, then we obtain a gross loss. In that case, the balancing figure will be on the CR side. The gross loss will be written on the CR side. Then after it has been written on the CR side, it is brought down on the opposite side as an expense. So we have now these totals, and then make sure you underscore your total so that it shows that you've actually bring your statement to an end. So this part is called the trading account. Now we finish up with the profit and loss account in the same statement. So on this side, we record here revenues or expenses, or incomes. Revenues or incomes. And the first revenue will be the gross profit brought down. Remember, when we are balancing, we carry down, CD. When we are now bringing to the next financial period, we bring that figure down as our initial balance to start off the records for the incomes. And then on this side, we record expenses. We capture expenses. And there are so many expenses, depending with the business and the nature of operation it is. So we can list some of the expenses. For example, salaries could be an expense that is incurred. We can have what we call advertising expenses. Some businesses will be paying rent. That is an example of an expense. But more importantly, you need to understand what we call carriage. We have what we call carriage outward. Carriage outward is an expense. Then we have discounts. We have discount allowed as an expense, plus so many other expenses that we can think of. What is important is, in most cases, before you analyze the trading and profit and loss account, you will be given a statement we call the trial balance. Now, get to know, where do we record? Which side of the trial balance captures the expenses? And from your understanding, from the understanding of ledgers, you are told that when you're talking about an expense account, expenses have debit balances. When talking of an expense account, they all have debit balances. Their balances is on the debit side. When talking about revenues, they have credit balances. Therefore, it means all expenses will be captured on the debit side of the trading profit and loss account. And so incomes will be captured on the credit side. So let's see, what are examples of the incomes here? We have discount now received. Discount received. Once we have discount received, we can talk of commission. Commission received. We can have what we call rent income, because rent could be in either case as an expense or as an income. Then once we have captured all these records here, then we obtain the total for each side. If you realize that your business has more incomes than expenses, then we have what we call net profit. So if the incomes are more than the expenses, we obtain net profit. That becomes our balancing figure. Net profit carried down becomes the balancing figure. And then the total should be the same for both sides. And then we bring down the net profit on this side. Balance brought down. So we shall have prepared our statement, which is the trading profit and loss account. Now, number two, once we know how to prepare the trading profit and loss account, we need to understand how we are going to calculate the ratios. Because this topic is about financial statements and ratios. So how do we calculate ratios from these statements? That is what I want us to discuss now. We discuss how we calculate different ratios that are very important in our lesson. Now, the first main ratio that we need to know is what we call markup. That is the first ratio. We can call this one financial ratios. Financial ratios. So how do we calculate markup? How do you calculate markup? The explanation of markup as a ratio, as a financial ratio, is simply a ratio of the gross profit to the cost of sale. We express markup either as a percentage or as a ratio. Therefore, when you're calculating markup, we use the formula gross profit over cost of sale. It can either be as a fraction, or we can say gross profit over cost of sale times 100 to get it as a percentage. So we give it either as a fraction or as a percentage. That's how we calculate markup. So you'll simply come and take this figure and then compare with this figure. If this is 50 and this is 100, then we take 50,000 over 100,000. That will give you the markup. And then either as a percentage, you multiply by 100, or you leave it as a fraction, it will still be okay. Number two, we are going to calculate what we call margin. Margin is now the ratio of gross profit versus or against net sales. We compare gross profit and net sales. That one is called margin. And so the formula for margin is going to be gross profit over net sales. Over net sales. So this one will help us to determine how much have we been able to acquire out of the stretch of the gross profit that we've been able to make as a business. Now, remember, the business operates on a case of, we say the main purpose here is to make profit. And so when we are calculating, we need to remember there's also what we call return on capital. Return on capital. How do we calculate return on capital as a ratio? Return on capital, we calculate this. This is simply a ratio. We explain it as a ratio of net profit to the capital invested. To capital invested. And we can express it also as a fraction or as a percentage. Net profit to capital invested. That means, therefore, we take net profit over capital invested. Net profit over capital invested. That is how we calculate return on capital. So at the end of the day, the business owner is able to ascertain how much did he or she make in relation to the amount of money he had actually invested in the business. And at the end of this topic also, we are going to discuss the types of capital. We have, for example, capital invested as the one I've mentioned here. We've borrowed capital. Those are types of capital that we need to look at. But in this case here, we concentrate on how much capital did you invest as the owner. In other words, what is the owner's equity in the business? Then we need to also look at what we call rate of stock turnover. Rate of stock turnover. We abbreviate it maybe as ROSTO. Rate of stock turnover. Now, what is rate of stock turnover? This is simply the number of times stock is exchanged. How many times are you going to exchange stock within that particular period? Because remember, stock is a current asset. And the essence of having current asset is actually to be able to see how fast they are going to be exchanged within that particular period that you're operating. If it is within 1 year, you need to exchange many times so that you can be able to tell how much profit you are making. If you exchange twice in a year, you are not going to be the same with the person who has exchanged stock 5 times a year. And so we look at rate of stock turnover by looking at the cost of sale. Cost of sale against average stock. Cost of sale against average stock. And in this case, average stock is determined by opening stock. We add a closing stock. And then we divide it by 2. That is how we get cost of sale. So how we get average stock. Opening stock plus closing stock, and then we divide by 2. So the figure that we get here, we now divide it by cost of sale. And remember, cost of sale where it is captured. This is where we have the cost of sale. So those are important ratios that we need to look at in the calculation. Maybe we need to also to add, we have what we call current ratio. Current ratio is used to show how the current assets are behaving against current liabilities. Remember, when you have current liabilities, the more liabilities you have as a business, the more troublesome you are. So you need to see how do you compare the rate at which the current assets and current liabilities are compared, and that ratio is called current ratio, is given by current assets over current liabilities. And from your understanding of the introduction to accounting, you are told what are current assets, you are told what are current liabilities, because those are simply types of assets and types of liabilities. So those are key financial ratios that we need to calculate today in our lesson. However, there is also a ratio that I will ask you to look at, what we call the acid test ratio or the quick test ratio. We have what we call acid test ratio or quick test. Though in our question we may not calculate this, but this is simply a ratio that is going to be helpful to show how business is going to convert current assets, how it's going to convert current assets in order to settle the current liabilities. But remember, there is exclusion. We don't include stock. So it is the conversion of current assets excluding stock to settle current liabilities. Because at the end of the day, the business has to be able to settle the liabilities if it has to be able to go to the measure of making higher profits that is required for the business. So these are what you need to consider when we are looking at our lesson today. So let's then take an example and see how do we calculate all these ratios and how do we prepare our statement. Our question then, we will take a look at one question. This is our question of, we are told that the following balances were extracted from the books of Mwakideu, traders. That is book of Mwakideu traders. We have capital, that is 200,000. We have purchases given as 100,000. We have sales given as 350,000. We have carriage inwards given as 30,000. We have carriage outward given as 40,000. 40,000. We have return outward. Return outward, remember we say return outward means purchases returns, and that's given us 10,000. We have return inwards. Return inwards given us 20,000. 20,000. And then we have discounts. We have discount allowed. Discount allowed here is given us 60,000. We have salaries. Salaries which are given as 30,000. We have discount received. Discount received, which is given as 20,000. We have advertising. Advertising given as 10,000. We are given stock, and in bracket it is written 1/1/2017. That is on 1st January 2017. That is 70,000. And then we have rent. Rent given as 15,000. We have land. Record for land is also given. That is 210,000. And then we have the record for cash given as 46,000. Further, you are told additional information is also given. Additional information. We have number one, we have prepaid salaries. Prepaid salaries amounting to 10,000. We have accrued rent. Accrued rent amounting to 5,000. And then finally we have closing stock. Closing stock amounting to 30,000. Amounting to 30,000. You are required. You prepare trading profit and loss account. Prepare trading profit and loss account for the year ended. For the year ended 31st December 2017. So this is a 1 year period from 1st January to 31st December 2017. That is the question that we have. But then once we have prepared the statements, we are going also to see how we can calculate the ratios. I want to explain something small concerning these entries that we've made here. These balances have been indicated as balances for Mwakideu traders. These balances, as they have been captured, they have been made simpler for you to understand how they are. But there comes a time when you will be given a trial balance. And remember, a trial balance is the simplest statement that we have, only showing indication for the details of balances on the debit side and credit side. So if you are given a trial balance, I want to use an illustration of returns. And then we write returns. And then the figure written here is 70, and then we have here 20. Then you'll have to understand what these returns are. Because we have two returns. We have returns inwards and returns outwards. So which return has a debit balance? And which return has a credit balance? That is, will help you to identify what is the return inwards and what is the return outwards. So if you look at return outward, we say that return outward are simply purchases returns. You had purchased goods, but now you take them back to the supplier. The reason could be the goods were defective, or they were of wrong quality, or perhaps the goods were not the ones that you ordered for in what we call the LPO, the local purchasing order. When you are making the local purchasing order, did you order for plates? If you ordered for a place and they brought cups, then definitely you'll have to take them back. So in that case, we have what we call purchases returns. So purchases returns have an effect on stock. How do they affect stock? They reduce the value of stock. And if they reduce the value of stock, then we say stock as an asset. When it reduces, we credit. And therefore, this balance here is what we call purchases returns. Purchases returns. Therefore, it means purchases returns are credited in the trial balance. They have a credit balance. And sales returns have a debit balance. Number two, you also need to identify something called discounts. The discounts, we could also write discount. And then indicate here 100 and indicate here 50. Then now you'll have to ask yourself, which discount are we talking about? We have two discounts, discount allowed and discount received. So how do you distinguish between the two to identify which one is on the DR and which one's on the CR? It's very simple. Get to know what's a discount allowed to the business. It's an expense. All expenses have debit balances. Discount received to a business is an income. And all incomes or revenues have a credit balance. So you'll be able to tell this is discount allowed and this is discount received. That is how we identify such kinds of tricks that the examiner may bring to students. So let's then handle this question and see what we need to prepare. We have Mwakideu traders, so we'll prepare our statement. We'll say Mwakideu traders, that is the name of the business. Mwakideu traders. The name of the statement is trading profit and loss account. Profit and loss account. And we are preparing it for the year ended 31st December 2017. We are preparing for the year ended 31st December 2017. So let's see. We have the DR side. We have the CR side. See the entries. We said the first thing you need to do in the trading profit and loss account is to record the opening stock. So we record our opening stock. The value for the opening stock is given. We have this stock here and this. So it is clear to know that this is the opening stock because this is on 1st of January. We record it as a 70,000. 70,000. Then number two, add purchases. Do you have purchases for Mwakideu? Yes, we have purchases worth 100,000. So we add purchases. We add purchases, which is 100,000. Number three, do you have carriage inwards? From the entries, yes, we have carriage inwards, 30,000. So we add carriage inwards. Carriage inwards. Carriage inwards, 30,000. Number four, do you have purchases returns or returns outwards? And from Mwakideu, the balances, we have purchases returns, 10,000. So we subtract returns outwards or purchases returns. So that is 10,000. Now let's work out this. This is 70, 170. This is 200 minus 10 gives us 190,000. 190,000. And this figure, we call it the cost of goods available for sale. What is available in the business for sale? That is what we have as 190,000. Then we subtract closing stock. We subtract closing stock. The figure for the closing stock is given in the additional information. That is given as 30,000. So we subtract 30,000 to obtain 160,000. And this figure, we call it cost of sale. That is cost of sale. At that stage then, you move to the right-hand side, to the credit side, and now record the entries. And the credit side has only two entries that we need to make. One is the entry for sale. We record sales because sales is given here as 350,000. So we record 350,000. We subtract sales returns. We subtract sales returns or returns inwards. That is 20,000. Returns inwards, 20,000. This gives us a figure. We have 330,000. And this one is what we call net sales. Net sales. So we compare this figure with the cost of sale. If you compare these two, you'll realize that the net sales is higher. The net sales is higher than the cost of sale. And we said when the cost of sale is less than the net sales, then we obtain what we call gross profit. So what is gross profit in this case? It is simply 330,000 minus 160,000 to get 170,000. So we write 170,000, and this becomes our gross profit. Because it's the balancing figure, we call it gross profit carried down. Now, that is the end of the trading part. We go to the second part, which is the profit and loss account. In the profit and loss account, we mentioned that we record expenses on the DR side and incomes on the CR side. So we only drop gross profit as the first income. So here we have revenues, and then we have our gross profit brought down. That gives us 170,000. And this side we record expenses. So we'll go to our entries again and see. Capital, we've not captured it because that will go to the balance sheet. We are at the stage of carriage outward. And carriage outward, we said, is an expense. So we record it here, carriage outward, carriage outwards. Carriage outwards given us 40,000. This is 40,000. We go to the next. We have discount allowed. So we record discount allowed. Discount allowed. Discount allowed in this case is 60,000. 60,000. And then we go to salaries. Salary is an expense again. Unless stated otherwise, salaries will be an expense. Something you need to remember. Salaries is given us 30,000. Prepaid salaries is given us 10,000. We have to make an adjustment because we have the value for the salaries within the year, and then we had made prepayments before. So we had made prepayments of 10,000, and the figure is 30. So we said when you have prepaid expense, we simply subtract. So take 30,000 minus 10,000, and then that gives us our figure now, 20,000. So the salaries is 20,000, not 30, because of the prepayment. Then if we had been asked to prepare a balance sheet, we will transfer prepaid salaries to the balance sheet as an current asset, meaning it will be debited on the balance sheet. I hope that is clear. Let's go to the next, advertising. Advertising. Our advertising figure is 10,000, so we record 10,000. Stock is an asset, so that we have already captured it also. With rent. Rent is also adjusted because we have accrued rent of 5,000. We said when you see accrued or due or outstanding, it means the same. So when you have such kind of case, you make the adjustment by adding to get the figure to record in the profit and loss account. So we'll take our entry here, which is 15,000. We add the accrued rent, 5,000. We add accrued rent, 5,000. This will be 20,000. So in this case then, when you're preparing a balance sheet again, you need to know accrued rent will go to the balance sheet on the credit side as a short-term liability. So we finished all the entries concerning the expenses as far as the question is concerned. And then now we need to look at the incomes. And from the entries, we only have one discount received. So we'll record it here, discount received. Discount received, which will be 20,000. This will be 20,000. And so we need to add and see which side is higher than the other. Definitely, you can easily tell that the CR will be higher than the DR. So to obtain the figure, the CR has a total of 170,000 plus 20,000, that is 190,000. And so we add this. This is 60, this is 100,000, 120, 130, 150,000. So this side has 150, this side has 190, meaning you have more incomes than expenses. So definitely you make a profit. So we say now that is called net profit. We say that one is called net profit carried down. Because this is 150, this is 190, our figure now is 40,000, the difference between the two. This net profit is brought down. At this stage here, net profit brought down 40,000. So we shall have prepared our statement, trading profit and loss account. Now, what we do is we mark entries here. Every entry you make is a mark. Every correct entry is a mark. So ensure you have captured the information so correctly, because if you transfer wrong figures, you will not score. Ensure you record the correct figures so that you are able to obtain the maximum score in this question of trading profit and loss account. And as you all, candidates should be preparing for this, because this is one of the questions that is common in paper 2. One of the questions that you must be able to know and prepare so much is the trading profit and loss account. And that is how exactly we prepare the trading profit and loss account. Therefore, someone will be asking, where is land? Why have you not used land? Why have you not used capital? Why have you not used cash? These are important questions. Capital will have been used if at all we had been asked to prepare the balance sheet, because these are entries to the balance sheet. Land is an asset. It is prepared or recorded in the balance sheet. Current is a current asset, also recorded in the balance sheet. And then again, after preparing the trading profit and loss account, if the examiner asks you to be able to extract a balance sheet, he's only trying to see if the figure you have as net profit is going to be now the correct figure in conformity when you're preparing the balance sheet, so that when you transfer the net profit to the balance sheet, you have to add to the capital. Remember, we said also, you should be remembering something. Capital is affected by four main things, or four main factors. Capital is affected by profits, and in this case, net profit. And net profit has an effect of it increases capital. You can be told, maybe you explain factors that affect changes in capital. One of them is profits, and more particular, net profits. They increase capital. Number two, losses. If you make net losses, they are going to reduce capital. Number three, additional investments. Additional investments have an effect of increasing capital. This one increases capital. And then number four, we have drawings. Drawings reduces capital. So those are factors that affect capital. So in that means, therefore, when you're preparing the balance sheet, on the CR side, we have the record for capital. Take the figure for the capital, in this case, 200,000. We add net profit, which is 40,000, so that we now get the figure that we'll have. If we had been given drawings, we'll subtract drawings, and then we can also subtract losses, that if there were losses, and then add additional investments. And that is how we prepare. And then I've also said the transfer of the other entries. Now, and then lastly also, if you had been given provision for depreciation, when you're transferring the figure for the asset to the balance sheet, you have to take that figure. If you had the record for machine or machinery, that is 50,000. And then there was a record for depreciation. The figure had depreciated by 5%. Then to record or to transfer machinery to the balance sheet, because that is an asset, you take the record, the balance of the machine, 50,000, we minus 5% of 50,000. That is what you'll enter in the balance sheet. 50,000 less 5% to be now transferred to the balance sheet. So that is what we need to understand in this case of preparation for the trading profit and loss account. Using this, therefore, let's be able to see, though the question did not ask, but I want us to analyze it because it is what we are learning today. I want to analyze the ratios that we've talked of and see how do we calculate these ratios using the figures that we have. And the first ratio that I want us to be able to calculate is what we said is called margin or markup. How do you calculate markup? How do you calculate markup? Let's say part B, determine. The first one is markup. Determine markup. We want to use this information to calculate these ratios. We determine markup. Now, we said that markup is simply a ratio of gross profit against the cost of sale. So we need to ascertain now from the figures we have, the gross profit is 170. So I will take 170, this gross profit over cost of sale. 170,000, which is the gross profit. Our cost of sale is 160,000. So we divide this one by 160,000. This cancel out, so we have 17 over 16, and we said we give it as a fraction that becomes 1 over 16, or give it as a percentage, 17 over 16 times 100. 17 over 16 times 100. That will give you 1700 over 16. If we do the simplification, that is 8, that is 50, that is 25, that is 4. Then we have 25, that is 25 by 17. 5, that is 5, 8, 4, 3, giving us 5, 2, 4, then divide by 4. If we divide by 4, that will give us 10, 10, that is 10, 14, 18 point. If we divide, that will give us 14, 425, 425 over 4, that is 4, that is 1, into z, that's 0, into 25, 8, then point, that we are left with 1 into 2. That becomes our figure. So we can calculate markup as that. If you are not asked markup, maybe they will ask margin. If we are asked margin, we said margin is gross profit against the net sales. So gross profit in this case, 170,000 over net sales, 330,000. 330,000. This cancel out, and so we are left with 17 over 33. That is our second ratio we call margin. Very important. Let's see how many times we exchange our stock, and that means then we calculate a ratio we call rate of stock turnover. Rate of stock turnover. Rate of stock turnover. I've indicated to you that rate of stock turnover simply means you take the cost of sale divided by average stock. Cost of sale divided by average stock. So what is the cost of sale? We have it is 160. What is the average stock? That is what we need to determine. Average stock is given by the opening stock. We add the closing stock, divide it by 2. Our opening stock in this case is 70,000. 70,000. Our closing stock will be 30,000. So we add 30,000. Then we divide by 2. That is 100 divided by 2, giving us 50,000. So our average stock is 50,000. So we now calculate, based with this cost of sale, therefore, that is now our rate of stock turnover, will be equal to our figure for the cost of sale, which is 160,000. 160,000. We divide by the average stock, which is 50,000. Divide by 50,000. We cancel this cancel out. So that gives 3, that is 15, 1, that is 3.2. Now the figure for rate of stock turnover is given in terms of times. So we say 3.2 times, or simply round off to 3 times, meaning that the stock was exchanged 3 times within that period. We've exchanged our stock 3 times within 1 year. That is now what we call the rate of stock turnover. Lastly, we can also calculate what we call return on capital. Return on capital. Return on capital. We said return on capital is given by net profit over capital invested. Over capital invested. Net profit over capital invested. We have our net profit, which is 40. So we write 40,000. Capital invested, in our case, was 200,000. So we divide by 200,000. So that this cancel out. That is 41415. That is 1 over 5. Or as a percentage, we'll say 1 over 5 times 100, which will give us 20%. So it means the rate on capital, the return on capital is at 20%. So those are basics that we need to understand in this topic, financial statements and ratios. Get to know that the examiner will be asking you questions from this. Preparation of the trading profit and loss account as one statement, or preparation of a single trading account, or preparation of a single profit and loss account, and then the calculation of the ratios. I gave you many ratios, but I've calculated ratios that are best with the question that we have today. That is the 4 ratios that we've been able to calculate are very key when you're looking at financial ratios and financial statements and ratios. But very importantly, though most students do assume this part, the types of capital. Get to know what are the types of capital that we are going to use in this topic. I've mentioned one here. We have capital invested. We have capital borrowed capital as also one type of capital. That is the last part on this topic that you must be able to revise and prepare on them. I think this now is enough for the topic, financial statements and ratios, where then we come to the end of our lesson today, where we've been able to analyze the 5 areas of testing in this topic. So next time we'll be able to look at something also different in accounting and see how we calculate or bring out statements that are required in this subject. Thank you for watching KUTV. Once again, I'm Teacher Elfas, and I wish you a nice day, a nice way. Revise business studies, accounting, and make it simpler from now henceforth. Thank you.
Turn your 50 bob into a million shilling investment. Changamka and Shindagari Chap Chap with Hometel. There's millions in shillings worth of prizes to be won. Send your 50 bob to paybill number 4040153 and get a chance to win 20,000 shillings daily. And each week, one person gets a chance to walk away with a Mazda Demio and another a Beth Mobility motorbike. Remember, the more times you try, you could be the winner of a fantastic Toyota Prado. Do not be left out. Send 50 shillings to paybill number 4040153, account name KU, and get yourself a Hometel lucky number. Changamka and Shindagari Chap Chap with Hometel promotion. For more information, visit www.shindagari.co.ke. Terms and conditions.
Kilimo ni nguzo kubwa kwa ujenzi wa taifa, kwani kilimo ndicho huboresha maisha. Ukitaka kujua haya usipime kipimo, na ukikaa nasi basi utaboresha kilimo.
Ni Jumamosi nyingine marahaba, tunakutana katika kipindi kipenzi cha wakulima boresha kilimo. Hiki ni kipindi ambacho kinaangazia nyanja mbalimbali za kilimo, teknolojia ibuka, hali kadhalika kilimo asili. Hii leo tunatupia jicho mseto wa wakulima ambao wanachangamkia nyongeza ya mazao shambani. Popote ulipo, hujambo. Mimi ni Laban Shaban.
Kilimo ni nguzo kubwa kwa ujenzi wa taifa.
Yamkini wakulima wengi wanajinyima fursa ya kupata faida maradufu kwa kutokumbatia nyongeza ya thamani katika mazao yao. Nini cha mno kilijiri katika msimu uliopita wa boresha kilimo? Wakulima wafuatao walijua siri ya kuongeza natija shambani.
Here we are located in Thika along Kandara Road. So here we are doing strawberry farming, and we have different varieties of strawberries, but specifically the one that is most popular in Kenya because it is high yielding and it has also sweet fruits. It is the Chadra variety. That is what we have grown here. And the strawberries are rich in vitamins, in minerals, so they are quite healthy source of food. And they also they can either be eaten fresh or they can be processed into jam, yogurt, milkshakes. They are also used in cosmetic industry. They are also used to extract strawberry flavors that is used in different products. So the list of their uses is endless. The other beauty with the strawberry farming is that you can do the strawberry farming even with very limited space. You can either plant strawberries directly on the ground as we have done here. Also you can plant them on containers. So even if you don't have such a piece of land, even at your backyard or even in your veranda, you can still be able to grow strawberries and get that rich and very healthy fruits for your family. Here we have done about an eighth of an acre to start with, but we are expanding. This is the starting point, and we are expanding. Strawberries will grow in many parts of our country. They like an altitude of about 1,500 meters above sea level. They also do well in areas which has sunny spots in many periods of the year, because they grow best during the sunny seasons or the sunny periods, because for the fruit, for it to ripen, it requires about a minimum of 6 hours of sun per day. So, of course, with that in mind, it means that they can grow in many parts of our country. They will grow in many types of soil, so long as the soil is well drained that is, it is not waterlogged. And of course, it is not very sandy, because again, in sandy soil, the retention of water is not as much.
This journey began in 2014 as I was schooling. Initially, I wanted to venture into medicine. Yes, I enrolled into that course, but I felt that I was not doing the right thing. So I opted to do something which I had passionate, and that is farming. So in this farm, I normally concentrate on farming dashin, arrowroot. Dashin arrowroot or dashin variety, it came from South America so many years ago. So before I started farming arrowroot, there are so many considerations which I considered. One, I needed a crop which will not require a lot of supervision, a crop which will not require a lot of capital. I did my research. I walked from one county to another, from one show to another. For example, I attended so many shows. The Agricultural Society of Kenya shows countrywide. I went to Nakuru, I went to Nairobi, I went to Mombasa, I went to Embu, I went to Meru. And I settled in farming arrowroot. Initially, we have several types of arrowroot. One, we have the Roko type, what we call the Adoe, that's the Roko type. We have the Taru, and now we have the Dashin. So out of my research, I settled in farming the Dashin. One thing about the Dashin, it takes less time to grow. Once you plant, it will take 5 months. Between 4